Let's dissect rolling. Simon Property Groups. While specific segment breakdowns are unavailable, we can infer some key drivers. Wall Street expected steady results, but SPG delivered a $197.9 billion, a massive 13. This suggests strong occupancy. But here's the kicker. GAAP EPS exploded to $9.35 rents. Given the lack of detailed data, we can't pinpoint the exact contribution of premium retailers or specific geographic locations. 5.2% dip from last year, but a solid 8.4% jump from last quarter. Is this a blip or a trend? We're diving deep to separate the hype from the hard numbers. Remember, this is educational content only, not investment advice. Let's dissect what fueled this performance. While specific segment breakdowns are unavailable, we can infer some key drivers. Revenue surged to $1.79 billion, a $190 million increase from Q3 2025. This suggests strong occupancy rates and increased tenant sales, which directly impact SPG's percentage rents. Given the lack of detailed data, we can't pinpoint the exact contribution of premium retailers or specific geographic locations. However, the overall retail landscape shows resilience, contrasting sharply with sectors like data centers, which saw strong real estate returns driven by hyperscaler demand. The key takeaway: SPG's revenue jump indicates a healthier retail environment than some analysts predicted. We need the 10K to see how much of this is organic versus acquisition-driven growth. Management commentary is key here. Let's gauge Wall Street. SPG's PE ratio hovers around 26.4x, 26.9x, slightly below the industry average. Analyst consensus leans towards a hold rating with price targets around $190 to $199. This suggests limited near-term upside from the current price of $191. However, it's crucial to consider the wide range of DCF valuations, with some models indicating overvaluation and others suggesting undervaluation. Headwinds. The market will be watching closely to see if SPG can maintain its momentum amid potential economic uncertainties. Remember, these are just projections, and actual results may vary. We need to listen to the earnings call to get a sense of management's confidence level and the assumptions baked into these numbers. Let's gauge Wall Street's temperature. SPG's PE ratio hovers around 26.4x, 26.9x, slightly below the industry average. Analyst consensus leans towards a hold rating with price targets around $190 to $199. This suggests limited near-term upside from the current price of $191. However, it's crucial to consider the wide range of DCF valuations, with some models indicating overvaluation and others suggesting undervaluation. This divergence highlights the uncertainty surrounding SPG's future growth prospects and discount rate assumptions. The key is to understand that analyst opinions are just one piece of the puzzle. We need to weigh these views against the company's fundamentals and our own investment thesis. Here's the bottom line. SPG presents a mixed bag. The revenue beat is encouraging, but the dip in FFO and the high debt-to-equity ratio of 9.59 raise concerns. The bull case rests on sustained occupancy rates, increasing tenant sales, and successful redevelopment projects. The bear case centers around potential economic slowdowns, rising interest rates, and the ongoing shift towards e-commerce. Given a neutral analyst consensus and divergent DCF valuations, a wait-and-see approach might be prudent. Key metrics to watch going forward include occupancy rates, same-property NOI growth, and progress on debt reduction. Remember, this analysis is for educational purposes only. This is not investment advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Key metrics to watch going forward include FFO growth, occupancy rate, and debt-to-EBITDA ratio.